I tell you, there's wealth creation and wealth destruction. And people should also consider the aspect of wealth destruction in their life. It happens all the time.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up. We're fortunate to have with us Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report. Marc has a PhD in economics and is a regular speaker at investment seminars. Marc, thank you so much for coming on to Metals and Miners and for joining us today.
It's a great honor and a great pleasure to be talking to you and your listeners and viewers.
Thank you. Okay, so Marc, President Trump's tariffs have triggered significant volatility and sell-offs in global markets with the Dow, S&P, NASDAQ. They're all experiencing their worst few days since the pandemic late last week and continuing into today, Monday, April 7th. How do you see these tariffs reshaping the long-term outlook for equities?
I'm not sure that tariffs are that relevant because there will be so many exceptions and adjustments. But I think, and I've written about this since December, the market since last year, say summer of last year to the peak in December, January, depending for the peak is for each stock different. The market was actually weakening and fewer and fewer stocks were making new highs. And in January, the high was just among, say, the Magnificent Seven stocks and so forth. And these stocks became grossly overvalued. But the investment community, of course, will never tell its clients that something is overvalued, because they are paid by the assets they manage and by the performance. So they kept on telling their clients that the stock market will go up and so forth, not realizing that we were in the biggest asset bubble we've ever been in history at the end of last year and early this year. And the market started to weaken. The tariffs were then declared, and the investment community, the fund managers, most of them, the dumbest people on earth, of course, they use the tariffs to tell their clients, oh, the market is going down because of the tariffs, when in fact, they made the mistake to tell their clients to buy right at the peak of the market. The market was so overvalued by any standard, and some people actually pointed this out, from David Rosenberg to John Hussman and so forth. They had statistically shown that the market was more overvalued than even in year 2000, from where the NASDAQ dropped 70%. But no, they kept on telling their clients, buy Tesla and buy NVIDIA. And Tesla, within, like 2 months, is down more than 50%, and NVIDIA 42%. These were the two most popular stocks among American investors and globally. I know people all over the world who were trading in and out of NVIDIA. And in options, and they were long leveraged funds. So the leveraged funds, the market is now oversold, but the leveraged funds still have to sell because their clients get margin calls.
Okay, so we're seeing this incredible market action. You're saying it's oversold at this point. Some folks are saying we're going to see a brief bounce and then it's going to continue back down. whatever the case may be with that, it seems that recession indicators are increasing. It was, 25, 30% chance of a recession just a couple months ago. Today, the reports are showing that it's as high as 60 to 70% chance of a recession. Given your expertise in spotting economic cycles, do you agree that, the recession is still maybe, or do you believe at this point that we're going to see a reverse wealth effect and a recession is baked into the cake?
I have maintained since last August that if the statistics were properly analyzed, we would be in recession already. But you understand, a recession, what is a recession? A recession is when your standard of living is going down. Now, for the rich people, as long as the stock market went up and as long as property prices rose, their standard of living wasn't going down. And for the recipient of money that the government was printing through its central banks, the standard of living was not going down. But for ordinary people who go shopping in the supermarket and buy food and have a salary, they are workers, they get a salary increase of, say, 4% per annum, but the cost of living is going up 8% per annum or 10% per annum. Do you think the standards of living are going up? No, it's going down. They're all in recession. 70% of America is in recession already. But the economists on Wall Street will never tell you this because they want the market to go up, so their fees go up. I'm a financial man. I know our industry is a fraud. It's a complete fraud. We print money. Nobody criticizes the Fed for their money printing. Why are most people struggling? Most families are struggling. But a few people are doing very well, including myself, because of the money printing. But nobody will go and say the Fed is a fraudulent organization.
Yeah, the devaluation of the purchasing power of the fiat currency has been going on for quite a long time. It does seem like it's gone exponentially, over the last 5 years or so, just gone on a rampage, causing more and more people to fall behind. Is that a call for precious metals ownership?
I have maintained for the last 35 years or 40 years, anyone who doesn't own any precious metals is a man who trusts the central bankers. Why would anyone trust all his money to the central bankers? And you understand, some people will say, I can't have that much gold because most of my wealth is in my house, because the house is the house in which the family lives, the children, the wife, and so forth. And so the asset allocation into gold cannot be much more than, say, 10%. But wealthy people who have, say, $1 billion and don't own a single gold share or a single ounce of gold, in my opinion, they are dumb. They are dumb. They trust people like Yellen, Bernanke, and Jerome Powell. How could anyone trust his wealth, these people? That I will never understand. And I mean, other people point this also out, is very clear. It's like Bitcoins. You cannot increase the supply of Bitcoins and gold and silver and platinum and any commodity as much as you can print money. So per unit of money, the price will be stable. The money will depreciate. It's not that gold is going up, but the money, the value of the purchasing power of the dollar is going down. And the government officials in America, the Bureau of Labor Statistics that calculates inflation, is another fraudulent organization because they say, oh, the inflation is 1%, 2%, 7%. When in fact, we have statistics that show how much the cost of living has gone up for ordinary people over the last 10, 20 years.
So, Mark,
look at shadow statistics.
Yeah.
They show at the present time an inflation rate of around 10% per annum. I think it's a bit lower, but nonetheless, the cost of living for ordinary people is going up much more than what the government is showing. I'm from Switzerland. The National Bank in Switzerland, they say that the inflation is practically non-existent. That's why interest rates are at less than 0.5%. But how come in all the international surveys, Swiss cities are among the 5 most expensive cities in the world? But they claim they have no inflation.
So are you anticipating moving forward from this day forward? Are you expecting greater purchasing power degradation than we've seen over the previous 5 or so years, or something on par with that? Are you expecting, in light of what's happening in the markets, are you expecting the Fed to come in and do a big print?
I have to laugh because in the Trump administration, you have a collection of very wealthy people, billionaires. Do you think they like it when their wealth suddenly is cut in half? No, they're going to put pressure on the Fed to slash rates and to print money. Because you said something that is absolutely correct and that economists don't point out. In my opinion, in today's conditions, economic conditions, the wealth effect is very powerful, much more than before. And this wealth effect will plunge the economy into a depression. They must print money.
Yeah,
they can't do anything else.
I'm sorry. Over the last few years, we've seen a huge correlation between the stock market and taxes. And when we saw the stock market take a dip in 2022, in 2023, taxes collected went down dramatically. So then, to your point, the reverse wealth effect, if this continues here in 2025, that means 2026 tax collections are going to be dramatically lower. And despite the fact that they're doing the Doge cost reductions and everything else, the debt is going to explode out, right? The deficit is going to explode out because of the lower tax collections, the negative wealth effect.
I'm not sure, but it's my impression that under Trump, the deficit will go up, not down, and that under Trump, money will be printed like never before. That is my impression, but I'm not sure.
Now, I'm sure you are extremely familiar with this debt wall of almost $10 trillion that's coming here in 2025-26 timeframe, and that global liquidity is right now indicating potential draining. Do you think this is happening timing-wise in order to get the Fed to print under the cover of the tariff situation, but in light of that, in order to help finance this huge debt wall?
Again, I'm not sure, but the market went down because it was grossly overvalued. The tariffs are not that significant. They're plainly stupid. Only a stupid person with no economic knowledge would introduce these tariffs. They're inconsistent and they are negative for the global economy. Let's put it this way. That I can say. But exactly why the stock market is selling off, I'm not sure. I suspect the market is selling off because the U.S. will soon attack Iran with Israel, in combination with Israel. That is my suspicion, but I'm not sure. The market is a discounting mechanism. It's going down because it is looking forward. The other reason it's going down, I think the earnings will by and large be very disappointing because through the tariffs, the costs will go up and the companies may not be able to roll over the tax. The tariff is a tax, may not be able to roll it over to the consumer because the consumer is stretched already. He doesn't have the money. Listen to the conference calls of Dollar General, of Walmart, of all these shops that sell to every American. The people are struggling. Even the upper middle class, they don't have that much money.
Okay, so those are all incredible points, and your perspective on a potential attack of Iran is something that has been percolating now for a month or so. This threat on Iran. I mean, how much of a disruption to oil supplies, et cetera, which would add further strain to the global economy than we already have, would occur from an attack on Iran? And are you viewing commodities, energy and precious metals in particular, in a much more favorable light in the event that an attack on Iran occurs?
Strictly on valuations, if I compare, say, how long you have to work, how much does a typical worker have to work to buy an ounce of gold? How gold, is it cheap compared to silver? Is it cheap compared to platinum? No. Is it cheap compared to wheat, soybean, corn? No. So purely on economics, gold is not cheap. But compared to the entire financial system, I don't think there are many investors that have more than 1% in gold. Seriously. They go to cocktail parties. Then the wives, of course, they go run around and smile and say, yeah, we have gold because gold went up. And then you ask, well, how much gold do you have? They say, we have a few ounces, and but it's meaningless in comparison to their wealth that may be $200 million or $500 million or $1 billion. People are grossly underweight gold. Central banks are underweight gold, especially the U.S. Treasury. They may not have any gold. Who knows? They don't want to audit it because they don't want to tell you the truth. So all I'm saying is, I think that my view is we were in an asset inflationary environment. 1980 to 82, it began with stocks bottoming out in 82 and bonds reaching a high in yields in 1981 when treasuries were yielding more than 15% on the 10 years. After that, we are in asset inflation. Everything went up, collectibles, stocks, bonds, and so forth. It came to an end in 2020 for bonds, and for stocks between 2021 and today. Because 2021 was the peak of the meme stocks, of the SPACs. Actually, I'm surprised that the market is as high as it is, because so many stocks have collapsed already by 90%.
Okay,
Tesla is down more than 50%.
Yeah, so your view is not unlike many others taking a similar viewpoint. The Fed coming in, printing again a big QE print. What kind of effect will that have on the markets, if any? And do you think more of that money will actually go into real tangible things versus financialized assets?
That's a very good observation of yours. Will it have an impact on financial assets, if any? I mean, what is interesting at the present time is usually when you have a sell-off in the market as we just had, bonds, treasury bonds, which are the safest investment basically in the world, they rally. Hasn't happened this time. In an environment such as we have now, usually the dollar rallies hasn't happened yet. It may happen, I'm not saying. But what is interesting is that bonds have not performed well. Now, it doesn't mean that bonds will collapse. I'm actually of the view in an asset deflationary environment. Bonds will, who knows how they will perform, but they will go down less than stocks. And in an asset deflationary environment, gold may not go up, but it may only fall by 10%, whereas the stock market is down 50%. Who knows? You understand?
Yes.
We're talking about relative. The problem with monetary inflation is that everything gets distorted. Everything is confusing. But the central banks, they keep on printing money. And in my view, what you said about taxation and so forth, in my opinion, the Fed has probably no option but to print money unless they want to create a depression.
Okay, so I don't want to put words in your mouth. It sounds to me like you're saying that we're in or moving into an asset deflationary environment. And, you know, the last major asset deflationary environment, the Great Depression, we did have one, you know, in 2008, but they curtailed that. Homestake mining was a beacon for the few who had invested in that gold mining company. They were basically printing cash for people. Do you see some mining, gold mining, et cetera, as an opportunity during a new asset deflationary environment?
Well, I have to say, I've observed several bull markets in the stocks and in the commodities and so forth. What is unusual in the current case is that stocks, gold miners have performed poorly compared to the metal, to the physical. And I've been thinking about this. Why? I think that there are lots of people in this world who are very wealthy, billionaires, and the central banks, they know that something is amiss in the financial system. They can see that the leverage and the derivatives and everything, something is wrong. And they say to themselves, okay, I'm fortunate, I'm a hedge fund manager, I've earned $1 billion in my life. I never thought I would be this rich when I was studying or not studying. And so they say, okay, I want to own something that keeps its value and is not paper money, is not paper. So they can see that gold shares are cheap relative to gold, but they want to have something physical and not financial. So they own a ton of gold or a ton of platinum or silver and so on. And the central banks around the world, they have, as a percentage of their assets, gold has gone down until recently. And in the last 5 years, gold has started to move up. In other words, they are buying physical. And part of the reason to buy physical are the idiotic economic policies of the U.S. to punish other nations and seize their assets.
Yes.
Then, why would anyone have an asset in America if the American government can arbitrarily seize it and take it away from you.
Yes,
You'd be crazy.
Yes.
I want to point out to these American politicians and the State Department, they are crazy to think that the world will ever trust them again after seizing assets.
So you've clearly made the case for owning physical, and that is undeniable. Owning physical gold, owning physical silver, platinum, etc. It's undeniable that everybody should have that. The question is, as gold is at 3,000, or maybe it goes higher, 3,500, 4,000, and the stock market continues to languish or consolidate and not move any higher. Maybe it's a dot-com bust kind of a move, or maybe it's a 70s, just not going anywhere for a decade kind of a move. As those periods unfold in the markets and people are looking for gains, they're looking for something, and they see, okay, gold is going up. Gold is 3,000. Gold is 3,500. Gold is 4. That's holding value, but I don't want to spend that kind of money. Maybe I'll move into GLD where it's a lot cheaper. It's a lot less expensive. I can get more bang for my buck, more leverage, so to speak, in their mind. And so, do you see a switch? Where some retail, maybe even some institutional, will say, I want physical, but I've got some allocation of physical, and that's quite expensive. Let's move over here where I can get a little bit more.
I want to explain to you what the mistake of your argumentation is. I think, of course, after 40 years of asset inflation, stocks going up, properties going up, bonds going up until 2020, collectibles going up, stamps going up, and so forth. The world is conditioned to play the game, the money game, by appreciation. Yeah. They are conditioned that something will go up. But I'm telling you that maybe, I'm not sure, but maybe investors should think not to make money, but how to lose less than your neighbor. Because if you lose 20% of your assets and everybody else in the world loses 50%, you are the king relative to everybody else. You understand? Everything goes down 50% and you only go down 20%. You're much richer than if everybody goes up 100% and you only go up 50%. So I think people should maybe consider the possibility of having a broad asset deflation, which has a negative, what you said, the reverse wealth impact. And then consider what is the investment that is the best, that will go down the least. This is my view.
Okay. All right. So looking
I want
ahead,
to be in, or try to be in assets that will lose less value than others.
I understand. Okay. So looking ahead, the interplay of President Trump's America First agenda, potential military escalation with Iran, and a weakening and a weakening global growth outlook, it paints a very complex picture. As someone who's long warned of systemic risks, what's the single biggest wild card that you're watching for this year? In other words, what has you worried the most right now?
Well, at my age, you worry about your health and so forth. But I think if you, as a common sense person, you don't have to be a sophisticated economist that has studied for years in faculties and so forth. But as a common sense person, you have to say there's something wrong with the financial system. It's not sustainable in the long run. There's something wrong with the political system. It's not sustainable in the long run that countries run these fiscal deficits and they borrow money at artificially low interest rates, and they think that eventually nobody will suffer. My view is that the global economy was this size, say, in 1970. It's now, say, this size, the global economy. But the financial system was this size in 1970. The stock market as a percent of the economy was this. And now it is a huge bubble, a huge bubble. And this huge bubble has boosted asset prices. And in my view, this huge bubble will have to be deflated sooner or later. That is my concern. And can you do it without pain? No. But the governments will try to make it without pain by printing money.
Yeah, I see the picture you're painting, and it's not a pretty one. Okay, I want to welcome everyone who's tuning into this fantastic interview with Marc Faber, co-founder, editor, and publisher of the Gloom, Boom, and Doom Report. This has been a wonderful discussion, and before we wrap up with our final set of questions for Marc, I want to just direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report titled "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content, even without premium. There's plenty of free content daily, so visit metalsandminers.substack.com to join and explore, and thanks for watching this interview. Now, I'm positive you've enjoyed the conversation with Marc as much as I have. Please let him know, hit the like and subscribe button, and leave a comment below the video. All right, Marc, we're going to finish off with our discussion with what I call a lightning round. It's what I had told you about off air. I'm going to ask you to rank a few assets as a buy or a sell by giving it a score of 1 to 100. 100 is an extreme buy, and a 1 is an extreme sell, okay? Then just give one sentence or two sentences as to why you take that position. This is a lightning round, so we're going to go through them pretty quickly, okay? If you're not following the asset, that's fine too. You ready?
I hope I understand it, but okay.
Okay, just give it a score. 100 is a buy, and a 1 is a sell. Somewhere in between a 1 to 100 would be your ranking.
Yes, everything is 50.
And then just give your reason why, but keep your reason.
Okay.
Keep your reason brief. Okay. All right. On a scale of 1 to 100, is gold a buy or a sell, and why?
I think it's 75 because the price is relatively high, but it's a risk not to own any gold.
Okay. Gold miners
is maybe 80 to 90% because they are relatively inexpensive compared to the S&P and compared to physical gold and silver and platinum.
Okay. Silver.
80, relatively cheap compared to gold. And the miners are also relatively inexpensive.
Okay, what would you give the miners?
90.
90. Okay. Copper.
70, because I like copper. I think there will be a copper shortage, but I expect I think we're already in a recession, but it will get much worse before it gets better. On the other hand, if the U.S. and Israel have the wisdom to attack Iran and create a World War III, I can tell you that copper will go through the roof.
Okay. Uranium. Okay, uranium.
I was positive about uranium. I'm less positive at this point.
Okay, what number would you put on it?
40.
40. Now, do you make a distinction between uranium and uranium miners?
No, about the same.
Okay. What about oil?
In view of a potential attack on Iran, I think investors should be long some oil.
What number would you put on it? 1 to 100?
80?
80. Okay. The NASDAQ.
-0.
Okay. You want to just give a brief explanation?
The Nasdaq is oversold. It will rebound, but it's so overvalued. I think most Nasdaq stocks can easily go down 50%. Easily.
Okay. S&P 500.
20%. 20. The S&P is heavily weighted by tech stocks that are grossly overvalued. And so there are stocks in the S&P that are not terribly expensive, but because the weighting is so heavy, heavily dominated by the Magnificent Seven and so forth, I think the S&P has a significant downside risk.
Okay. Short-term treasuries.
80.
Okay. And do you have a reason?
I'm not bullish. From a very long term, I think we've reached interest rates and inflation move in long-term cycles. We've reached a low of the cycle in 2020. From 2020 onwards, for the next 20, 30 years, we'll have an acceleration of inflation and of interest rates increases. But cyclically, we can be in a kitchen cycle where for the next 2 years, interest rates are stable or are coming down somewhat because of the poor economy.
Okay. What about long-term treasuries?
I think there are more than 11 trillion in money market funds and equivalent at the present time. Some of that money is all short-term money market funds. Some of it will move into long-term treasuries. So I'm actually quite positive about long-term treasuries. 80%.
80%. Okay. Now on a scale of 1 to 10, okay, with each representing a percentage, like 1%, 2%, where do you see inflation? Where do you see inflation ending this year, 2025?
Maybe around 4%.
Okay. So you think it'll go up slightly?
I think inflation is now higher than what the government is publishing. You understand?
Yes,
I'm
I do.
giving you now the bullshit figure by the government published.
Yeah, exactly.
So I think it will go. I think they will have to show higher inflation rates. But the present inflation, your cost of living, other families' cost of living at the present time is probably going up by about 7% per annum.
Yeah, I would agree with that. All right. Finally, the recommended portfolio allocation for decades has been 60-40, 60% stocks, 40% bonds. But that's vastly changing over the last couple of years. And in light of, our discussion on commodities and precious metals and the indexes, how would you roughly recommend to allocate a portfolio today?
Well, my portfolio allocation has been and remains about 25% in equities, but equities globally, less in the US and more in emerging markets, because emerging markets are very depressed relative to the US. Europe is very depressed, but emerging markets have a better future than Europe. So 25% equities, 25% precious metals and miners. My allocation is much higher in physical than in miners. And then 25% in fixed interest securities and in cash. And 25% in real estate. And 25% in whatever you like,
Okay.
collecting quotes. So it
Under,
adds up to 125%, but I have adopted the accounting standards of the government.
that was good. I appreciate that. Outstanding. Mark, thank you for coming on to Metals and Miners. This has been a lot of fun. Would you please share a key takeaway that you want viewers to keep in mind, and then inform them where they can learn about your work and how they can connect with you?
Well, I think when everybody thinks that he understands the rules of the investment game, the rules tend to change because the rules are made up by some people in the government and so forth and are unpredictable. My sense is that the entire world is conditioned by looking at real estate and saying, oh, my grandparents, they bought this piece of land at this price and now it is this high. The whole world is conditioned that everything goes up in the long run. But I can tell you many instances where things have gone to zero. And I want to stress this. Why? In most cases, it happened because of the socialists and the communists who expropriated wealth. That is the issue. The communists, they have destroyed wealth throughout the world. In Russia, they took everything away. The Bolsheviks. In China, everything away. I know people who were wealthy in Shanghai. They ended up in Hong Kong as clerks in offices working. And before they had properties beyond anybody's imagination, they lost everything. A close friend of mine was the richest Vietnamese in Vietnam. He lost everything. He had a suitcase in Hong Kong when he came to see me because he couldn't go back to Vietnam. I mean, I tell you, there's wealth creation and wealth destruction. And people should also consider the aspect of wealth destruction in their life. That happens all the time. Yeah. And but at the present time, people always think of making money in speculation, in the most speculative stocks about which they have no clue. They want to become rich. And yeah. I tell you, I've seen this wealth destruction and I've seen money creation and so forth. It depends what you want in life. If you want to be comfortable and sleep well at night, you have to diversify and you have to be prudent.
I appreciate that. Okay, well, how can everybody find your work and connect with you?
I'm not sure they want to find it, but I have a website called gloomboomdoom.com, all in one word. gloomboomdoom.com. And
okay,
under my name, Marc Faber.
Are you on any social media?
Yeah, I don't know the social media. I don't understand. I have a TikTok account, but I don't know how to use it. Okay. I have a Facebook account. I don't know how to use it. I'm not so interested in social media.
Okay, well, I will send everybody over to your website. I'll put that link up and everybody can click through and get over to you and check out your report. Mark, this has been a joy. I've really appreciated meeting you and our time together. I look forward to having you back on sometime soon. And everybody else, thanks for watching.
Okay, thank you. Sawadee krap.
I want to welcome everyone who's tuning into this fantastic interview with Marc Faber, co-founder, editor, and publisher of the Gloom, Boom, and Doom Report. This has been a wonderful discussion. And before we wrap up with our final set of questions for Mark, I want to just direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report titled "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio.